Okay, so let's look at a page for buying a put vertical now. And we're using the same stock price here as 12.55. And if we were going to buy a put option, which one would we buy? We'd always buy the put option directly above the stock price. So in this case, we're going to buy the 12.60 put. When we create a vertical for buying, we always want to now sell the option that's just directly below this price. In this case, it's the 12.50 put. So the stock price is right between our bought and sold options. In this case, it's going to cost us $5.20 to do that, which we know is always times 100. So this vertical is going to cost us $520. And we know from our defined risk formula that the max loss when we buy a vertical is the cost of the vertical. So the most we can lose in this case is $520. But what can we make? Well, remember, the difference in strikes is always the total size of the trade. When we add up profits and losses on a vertical, it always has to equal the difference in the strikes. And in this case, the difference in the strikes is 12.60 minus 12.50, which means $10, which means the total amount of this trade, profits and losses combined, has to be 1,000. If we can lose 520, what can we win? Well, of course, you're correct. It's 480, because these two numbers always have to equal the width of the strikes, and they do. So if we pay 520 for this, that's the most we can lose, which means the most we can win is 480. Rule number one, if we can lose more than we can win, what does that mean? Our POP has to be above 50%, and guess what? In this case, it is. Because we can lose more than we can win, our POP in this vertical instance is 52%, and that is buying a put vertical.